The lights on the New York Stock Exchange are going out. The tickers are freezing. And for exactly 24 hours, the financial heartbeat of the world's largest economy is going to flatline. If you are holding positions right now, or if you were planning to make a move on Monday morning, you are already too late. Wall Street is shutting down. And it isn't just a pause, it's a liquidity lock. Imagine this. You wake up Monday morning to a notification. Maybe it's a geopolitical flashpoint in Europe, maybe a massive data leak from a tech giant, or a surprise announcement from a central bank in Asia. Your instinct is to react. You open your brokerage app to sell, to hedge, to do something. But you can't. The buy button is grayed out. The sell button is dead. Your capital is trapped in a digital limbo while the rest of the world keeps spinning. That is the reality of what is happening this Monday, January 19th. The reason for the shutdown is the federal observance of Martin Luther King Jr. Day. It is a vital day of history and remembrance, but for the markets, it creates a unique and dangerous vacuum. While U.S. equity markets, the NYSE and the Nasdaq, are completely shuttered, the machinery of the global economy does not respect the holiday schedule. This creates what professional traders call asymmetric risk. Here is why the stakes are higher than you think. While American stocks are frozen, the London Stock Exchange is wide open. The Tokyo Nikkei is trading. The Frankfurt DAX is moving. If a major event ripples through those markets, the U.S. market cannot price it in real time. The pressure builds up behind the dam. You are flying blind, effectively holding risk in a portfolio that you cannot touch, while investors in Europe and Asia are actively repricing the value of the assets you own. But it gets more complicated. The shutdown isn't actually total. And that is where the trap lies for retail investors. While the stock market is closed, the futures markets, where the institutional giants hedge their bets, often remain open for partial trading sessions on platforms like the CME Globex. This means the smart money is still moving. They are watching the global tape and adjusting their positions in the dark, reacting to price action that you won't see reflected in your S&P 500 ETF until the opening bell rings on Tuesday. This creates a phenomenon known as the gap. When the opening bell finally rings at 9:30 a.m. on Tuesday, all the news, all the global trades, and all the pent-up orders from the 3-day weekend hit the system at the exact same millisecond. The price of a stock doesn't just drift from where it closed Friday, it teleports. If the sentiment turned negative over the weekend, a stock that closed at $100 on Friday might open at $95 on Tuesday. That $5 drop, it happens in 0 seconds. You don't get a chance to sell at 99, 98, or 97. You just take the loss instantly. This is the hidden danger of the Monday shutdown. It forces a slingshot effect. Volume dries up completely, meaning liquidity vanishes. Then, on Tuesday, liquidity floods back in like a tsunami. This transition from 0 to 100 creates extreme volatility in the first hour of trading after the holiday. Algorithms, which have been sitting idle or running on low-volume futures data, suddenly wake up and fire thousands of orders per second to reconcile the difference between Friday's close and Tuesday's reality. So, what happens next? History tells us that the day after a market holiday often sees confused price action. Traders are trying to digest 3 days of news in 3 minutes. You need to watch the pre-market data on Tuesday morning like a hawk. Do not rely on Friday's charts. They are ancient history. Look at the overnight futures. Look at how the European markets closed. That is your tea leaf reading. If you are a long-term investor, the best move is often to do nothing, let the turbulence pass. But if you are a trader, the Monday shutdown is a warning. Do not hold leverage over a long weekend unless you can afford to survive a massive gap against you. The market is sleeping Monday, but the risk never does. When Wall Street wakes up Tuesday morning, it wakes up violent, fast, and unforgiving. Be ready.